Good afternoon, everyone, and welcome to our webinar on trading a market opinion using exchange-traded funds. This is the latest in a series of live webcasts offered by TraderPlanet.com through collaboration with our community contributors and other well-known industry experts. Today is Tuesday, January 12th, and we're happy to have you with us today. I am Darrell, and I will serve as your host for today's session with Darrell Jobman, a senior analyst for TraderPlanet.com. Today's webcast takes place at a specific date and time, and therefore any opinions given by our presenter may change without notice at any time. Trading involves substantial risk of loss and therefore may not be suitable for all investors, and past performance is not indicative of future results. This webinar is being recorded and will be archived on TraderPlanet.com, so you will be able to review the material at a later time. You can also find additional previously recorded webinars among our other free educational resources within our site at www.TraderPlanet.com. Our distinguished presenter, Darrell Jobman, trades his own personal account and has been involved in the financial markets for more than 40 years. A decorated Vietnam War veteran, he has served as the editor for several agricultural publications before becoming an editor of Futures Magazine for more than 15 years. He has written and edited more than a dozen books and training courses on trading. While his mission is helping others succeed by learning the do's and don'ts of trading, his editorial contributions to TraderPlanet.com have permitted him to amplify this passion. We're delighted to have him visiting with us today. Please join me in giving a warm welcome to Darrell Jobman.
Thank you very much for that kind introduction, Darla. I hope your trading day and your trading week and everything is going great. We're almost up to 30 degrees here, so it's almost like spring, so we're feeling a lot better. And as I say, I hope your trading is going better, especially if you trade the grains after what went on this morning, January 12th, after the crop reports. But today's topic is going to be somewhat different than the grains or futures, stocks. It's going to be about exchange-traded funds, ETFs. Before I move into the ETF discussion, I should also point out that we have data provided for our charts by CRB. They've been around for a long time, have a long record of historically accurate data, and but they have been around long enough to know exactly what they are doing. Secondly, when we do get to the charts, you might want to switch to full screen mode to be able to pick up more of the detail in the charts as I go along and try to point them out. Now, what are ETFs? I know that you might have heard of ETs and so forth, but ETFs, relatively new, introduced in 1993. They're kind of like a I've heard of them described as a mutual fund on steroids. Mutual funds, of course, were introduced by the brokers in mid-70s. So what we have is another tool, another instrument that helps traders be able to trade in a little different way than what they had in the past. It's another instrument that has been created for them, for the brokerage firms to be able to sell. Now the ETFs, what you basically have is a basket or group of stocks or bonds or more recently commodities, some other investment vehicle that's kind of put together into this nice little package that you see here that the guy is constructing. The possibilities are almost endless. You can do it if you buy countries or areas. You can go by stock sectors, investing styles. You can go by big caps, little caps. You can go commodity specific. There are a lot of different things that can be done, can be traded with the ETFs nowadays. The major issues are names you might recognize like State Street Global Advisors, Barclays, PowerShares, Vanguard. Basically what they do is they put together a group of instruments and they're going to sell those to the public. Now the biggest comparison that can be made with the ETFs is with the mutual funds. ETFs, as you can see, have some similarities with mutual funds in that they allow some diversification into more stocks, and you can trade, for example, instead of trading one stock, you have a selection of stocks so that when one stock doesn't do so well, you have a basket there that might be able to offset what has happened in that stock and still give you some nice returns. You can imagine that if you can imagine the market's ups and downs in individual stocks and trying to pick them, this is a solution where you have the diversification to get away from the big market scares, the bad news types of situations. But there are some distinct differences. As you can see with the mutual funds, you have a portfolio of shares and size, and all this is determined by the managers. And secondly, these managers, these are actively managing. They're trying to find a way to get the best performance. Some years ago, I had a fund that was supposed to trade currencies, didn't do so well, and they decided, well, we got to hike up our performance rate, so they started trading other commodities, futures, and so forth in that particular account. Not what I wanted to do, because this was supposed to be my exposure to currencies. So they kind of defeated my purpose, but I had no control over it because a mutual fund was doing it. The other thing about mutual funds that's kind of a distinction that is not favorable is that the prices are set at the end of the day, the net asset value after the day's trading. And so what happens during the day, if you wanted to decide to get out all of a sudden, you can't. And your access to funds are relatively limited. You can get out at certain times, but you have some limitations on what you can do with mutual funds if you have those in your IRAs or 401ks, as many traders have had over the years. Now, when you look at the ETFs, you have, again, you do have the portfolio of shares, but they're set. They're the shares that you know. It describes a group of shares, for example, in the technology area will be Intel, it will be so-and-so and so-and-so in a certain size. Some of them will have restrictions that they cannot be more than 5% weight in a portfolio. There are a lot of different ways that ETFs are constructed. Again, they have this diversification. The key things that are the big benefits, the advantages of the ETFs is they trade like a stock, so everybody is pretty well familiar with the stock, and they trade throughout the trading session. They are not limited to a price at the end of the day, but you can get in and out during the trading session. Sell them short, buy them on margin. These are just like stocks. You can use all kinds of option strategies that are available. In some cases, they may have tax advantages. For example, if you have a mutual fund and some people decide that they would like to, cash out, get their money, that could trigger some potential tax issues for you, capital gains requirements and so forth. So you don't really control your own destiny in the mutual fund like you can with the ETF. So there is a tax advantage there. You have no minimum size with an ETF. You no holding period. You don't, not limited to get out by expiration date or anything like that. So there are some advantages that way that are similar to the way stocks are. And IRAs can buy what they're called short ETFs. If you know what the market outlook is going to be and you think